Welcome to The Explainer. Today, we're talking about December 29th, 2025. This was the day the music pretty much stopped for the market's year-long party. I mean, after months and months of climbing, everything suddenly hit a wall. So what happened? Let's break it down.
So yeah, the market's momentum just slammed into a brick wall. We're going to explore exactly why, starting with how that Santa rally stalled out. Then we'll look at a huge wave of profit-taking in big tech, a pretty wild bubble that burst in the silver market, and finally, what it all means for you and other investors heading into 2026.
Okay, so what exactly slammed the brakes on this big year-end rally? Well, to get the full picture, let's start by just looking at the closing numbers for the day.
As you can see, it was a sea of red. All three major indices, the S&P 500, the Nasdaq, and the Dow, all finished the day down, pulling back from what were record highs. And yeah, this happened on pretty light holiday trading volume, but that downward trend, it was unmistakable. It signaled a really clear and sudden shift in mood.
Now this pause wasn't driven by just one thing. It was really a potent combination of pressures both from inside and outside the market. Internally, the market was just hitting a ceiling. For example, the S&P 500 had tried and failed to break through that 7,000 level 3 times in the last week. That creates a kind of psychological wall for traders. And then, an external shock came along and really rattled confidence. Let's dig into those internal reasons first.
Right, so a huge factor behind the downturn was just plain old profit-taking. After an absolutely incredible run in 2025, a lot of investors in big tech decided, you know what, it's time to cash in our chips.
And what's really important to get here is that this sell-off wasn't because of some bad company news. Nope, it was simply because after a year of these massive gains, investors were just locking in those profits before closing the books on 2025. It's a classic year-end move, but the scale of it this time is what really caught everyone's attention.
To put this into perspective, just look at Tesla. After a monster run all year long, the stock dropped over 3% in a single day, and there was no specific bad news to trigger it. This was purely investors taking some money off the table before the new year.
You know, this speaks directly to a warning from the legendary investor Howard Marks. He basically said the most dangerous time for a market is when optimism gets so high that investors just lose their prudence. That feeling of invincibility, that might have been what set the stage for this sell-off. But internal profit-taking wasn't the only thing going on.
Okay, now let's turn to that external shock that sent ripples through the markets. One that had absolutely nothing to do with tech stocks. We're talking about a dramatic crash in a key commodity.
To really get what happened with silver, we first need to understand what a speculative bubble is. I mean, it's when hype and just pure euphoria push an asset's price way, way beyond what its actual value can support. And in late 2025, silver was in a classic bubble.
This chart, wow, it tells a powerful story. You can see the price of silver didn't just climb, it went parabolic. It shot almost straight up, blasting past $80 an ounce in this huge speculative frenzy. And then, this. The bubble burst, and spectacularly. Silver prices crashed over 7% in a single day. So what caused it? Well, regulators hiked margin requirements, which made it way more expensive for traders to hold these speculative bets. And then China announced new export controls, which totally shocked the supply side of the equation. So you had this perfect storm, right? Profit-taking in tech, and this external shock from commodities. And it completely shifted the market's focus. Suddenly, investors stopped celebrating 2025 and started getting really nervous about 2026. And this slide really captures that new landscape of anxiety. The conversation has totally shifted from just pure AI hype to much tougher questions. Like, will these massive AI investments actually turn a profit? How's a new Fed chair going to impact policy? And all of a sudden, geopolitical risks and a cooling labor market are back on the radar in a big, big way.
This all leads to a really fundamental shift in the market story. 2025 was the year of believing the hype. Well, 2026 is shaping up to be the show me year. The story is no longer enough. Companies, especially in tech, now have to deliver the hard numbers to justify those high valuations.
So if you're an investor, how do you navigate this much more cautious environment? Well, it seems like two pretty distinct strategies are starting to emerge for the year ahead.
Okay, so on one hand, you have the aggressive strategy. This isn't about abandoning AI, but it's about getting more specific, doubling down on the areas like inference and networking, where real revenue is actually expected to show up first. But then, on the other hand, there's the defensive play. This means shifting focus to high-quality, stable companies that generate a lot of cash and can basically weather any economic uncertainty until the picture for 2026 becomes a little clearer.
Ultimately,
This pullback late in December marked a really big turning point in market psychology. It shifted the whole mood from euphoria to examination. And it leaves us with a central, maybe billion-dollar question for the year ahead. After the year of AI hype, is 2026 going to be the year we finally face AI reality? Thanks for joining this explainer.